right, guys. Welcome to another webinar by Viking Capital. I'm your host, Vikram Raya, CEO, co-founder with my good friend, Judah Fuld. He's the Vice President of Acquisitions. Judah, welcome to the show, my friend.
Hello, everybody.
Absolutely. And we also have one of the partners on this project, Michael Holman, one of the developers. Michael, welcome to the project. Welcome to the show, and welcome investors and listeners to the Viking webinar. Today is a special event. We're going to talk about one of our latest projects, but it's also going to be a new type of project that we're introducing to the Viking ecosystem and its development. And we'll talk about the pros and cons, why we decided to venture into development, and we'll talk about sort of the economic climate and why it makes a lot of sense right now. So before we go any further, I just want to make sure all the technology and AV is working. We want to make sure everyone is beaming in from all over the country and make sure that all the sound and audio working. So if you guys could do me a favor, let's do the chat. And if you can put in where you're from and what part of the country you're calling in from, that'd be great. And maybe what's one thing you want to take out of the webinar. So let's get that. Okay, we got Jane from Gilbert. Okay, a local. Selena's from Southern California. Awesome. Jerry from Maryland. We got Northern Virginia. John. We got Julia from Boston. Awesome, guys. Avinash. Good to see everyone. This is fantastic. So Judah, as people are beaming in from all over the different parts of the country, what's your take on Mr. Jerome Powell and the Fed and things that are happening in our economy and our country?
There's so much to build up to this next meeting coming up next week that almost feels anticlimactic, right? The market's already baked in where they assume there's going to be a rate cut. If there's a rate cut, we can keep on the progress we've been seeing. If there's hints towards a second rate cut, there could be some fervor around that. It's not often you see so much hype and excitement on federal interest rates. So it's nice people see more excited about the world that we live in, but certainly excited for the benefits it'll bring to our industry, for sure.
Yeah, absolutely. And I want to definitely introduce Michael Holman in the coming slides. He is our partner from Overland Group. And we're really excited that Viking Capital has found a student partner like Michael, an established developer. Now, Michael, you've been developing properties, and your company's been developing properties for almost like 40 years, things like that. That's a long time.
Yeah. We've been doing it for about 45 years. In fact, you might have seen an older gentleman with the name Michael Holman on there. That actually happened. We actually got the man, the myth, the legend, Ken Holman, my father, who actually started it all. He wanted to pop in for a second. Somehow got my link to log in, but he was there. Yeah, we've been doing it for 45 years, hundreds of millions of dollars in development, thousands of units. It's been really fun.
That's fantastic. Okay, guys, well, let's get started. If you have any questions, we're going to make sure there's a time for a Q&A. We're also going to make sure that you guys have one-on-one access to us and our team. So there'll be a book a call button. Anytime you need to have your specific questions answered, we'll definitely have plenty of time for that. But we'll also have some time at the end of this presentation for some Q&A. So use the Q&A functionality on Zoom, and we'll also be monitoring the chat. I have my whole team on this call as well, so we'll be fully ready to facilitate all questions that you guys have. So thanks again for joining. Let's get started. So Viking Capital is our private equity company. We were founded in 2015. My partner and I, Ravi Gupta, we founded this company to help high-income professionals, doctors, dentists, and business owners, entrepreneurs really find an alternative beyond Wall Street to really create unparalleled returns outside of traditional equities. And so we chose real estate as our asset class. We chose multifamily as our specialty. And we've really drilled down into this asset class. And we're approaching our 10th anniversary. You know, when I started the company with Ravi many moons ago, it was just me, him. I think we had an admin, and then we've grown over the years, and we've been blessed to have such amazing team members. And so we've really fledged into more of a boutique private equity firm that is really focused on really capital preservation, finding these unique opportunities across the country. I mean, I keep Judah busy. I mean, literally combs through 1,500 to 2,000 deals to find just a few diamonds in the rough that work. Part of the reason why we're successful is we're giving that high white glove service to our investors while we're still creating more of an institutional sort of backbone and DNA. And we have, our CFO and Bill, we have Judah, our asset manager, Ed, who you'll meet later in the presentation, because he's very critical in how we felt comfortable getting into development. This beautiful slide deck was created by Ashley and her team. Chris and his team is actually on the ground right now meeting investors already interested in this deal. So things are happening live all over the place. And we have our rest of our support team there. So let's go to a little bit about me. technically shouldn't be here. I should probably be in a cath lab somewhere, putting a stent in someone trying to save their life. But I started my career as a cardiologist. That was my love and my passion. I really enjoyed it. I was actually part of a very successful cardiology practice. And that practice has actually become one of the largest in Maryland. And it's actually looking to go to the next level there. And I practiced it for many years, ended up starting several other businesses, a boutique medical clinic, a mentorship advisory firm, a medical staffing company. And then eventually I got myself into real estate. And it's been a blessing. And I really enjoyed my journey. We've been acknowledged by the Inc. 5000, one of the fastest growing companies. Forbes has recognized us. And so we made some good headway in the real estate space. And I'll let Judah say a few words.
Yeah, thanks. Again, great to be with everybody on this webinar. For those of you who have not gotten a chance to talk to me yet, which I understand is a lot of you tonight, my background also atypical for the real estate world. I actually started on the legal side of the equation. After going to law school, I practiced litigation for a number of years, moved then into real estate law. I always had somewhat of an interest in the investment world. I had gotten some CFA progress along the way. Once I started talking investment theory and talking shit with my real estate clients, I knew it's where I wanted to be. I moved on to the investment sales side for a couple of years, some capital markets advisory, before getting to my destination of the buy side, joining Viking Capital more than 4.5 years ago. Vic does keep me busy. We look at a lot of deals. We are excited to now enter the development space as well. Ground up construction is something that we've been eyeing for a while, for reasons we really hope to share with you in a couple of moments, and excited to partner with Michael on this as well. So a bit about me, happy to tell you guys more. Again, book a call, any of us, and we're happy to chat more.
So the reason why we felt comfortable getting into development is because, it's sort of a step ladder. First things, you do small deals, then you do medium-sized deals, then you do big deals. And you start with like ugly-looking deals and decent-looking deals where you probably potentially could stay. And then finally you're like, oh man, I would love to live there kind of deals. And so that's sort of the graduation, the ladder we all climb. And then, there's a few groups out there that actually make the leap to go into either different asset classes, or they get into where, this is a same vertical, but just earlier in the process where, we bought deals from developers and now we're becoming the developers. And so Ed has been a phenomenal asset manager, and we knew he was amazing and he was going to really help us manage our assets. That's why we've never lost a single investor dollar. We've never had to do a capital call. And so we credit that to our power of our asset management team and, hopefully wise selection in assets. But the second thing that Ed is known for is he developed almost $1 billion of assets in his previous life before he joined the Viking. And so he's done this, tried and true, over 7,000 units, 26 properties. So he gave us the confidence to know, hey, look, there's certain ways to do it. And if you do it the right way, your investors are going to thank you for it. And so he said, I asked him, hey, bluntly, hey, you've done 40 deals in your lifetime. Of the 40 deals, what made the most money for your investors? And he goes, it was development. And so once we knew that, we're like, all right, how do we do it? What's the right way to do it? And that's when I want to introduce our next guest here, introducing the Overland Group and Michael Holman. Michael, take it away. Tell them a little about your history. Tell them about your comfort level with the Arizona market, and obviously how you're able to, a lot of the challenges of building is staying within budget, staying on time, and timing things well, and predicting where demand and supply is going to be. So just share with us some of the experiences.
Yeah, absolutely. Thanks, Vic. So yeah, Overland Group, we've been around for about 45 years. Like I mentioned earlier, started by my father, Ken. During that time, we've been all development. So Ken got his start a long, long time ago in property management, quickly went to development, and has been doing it ever since. Collectively between the three principals of the group are myself. It's a family-owned company. So myself, my brother Dave, who runs construction, we're a general contractor, and then my father, who oversees everything. Collectively, we have over 75 years of experience between the three of us. So it's been really fun. I've been here for 7 years now. In a former life, I was a CPA. So I worked at Ernst & Young, got my CPA. Maybe it was busy season. Maybe it was one too many inventory counts, whatever it may be. The next thing I knew, I ended up at Overland Group and really never looked back since then. So it's been magical.
I got to intervene here. So we got a recovering cardiologist, a recovering lawyer, and a recovering accountant on this call. Wow. Interesting.
Exactly. So our main office is in Salt Lake, and then we also have an office in Phoenix. So we are very active in both the Salt Lake and Phoenix markets. In fact, most of our construction right now is in the Phoenix marketplace. We have multiple projects under there. We have about 200 million currently under construction in Phoenix, and across 2 big projects, and then also a hotel that we're doing as well. And we have about another 150 million just in Phoenix in the pipeline. So we have a lot going on. We're doing a lot more third-party construction in Phoenix as well. here you can see some of our projects. This just gives a slight sample, but I mean, it's been awesome. The most recently completed is we have the Falls at Chrisman Commons. That one's in lease up. We have Avondale Commons Apartments, which is 324 units going. Really, the interesting thing that I hear, right, and I'm just going to insert this 2 seconds, Vic, if that's okay, is the fact that a lot of people are starting to look into development. I mean, I was just at a conference in Denver on a panel, and there's a lot of development interest that's peaking right now. And it's because with the lack of development that's happened over the last couple of years, you're now in this unique position where doing development now and getting started in the next 6 months, you're going to be the only new product, for years. And so it makes for a very intriguing story. And when you start looking at development right now.
And as we go to, you got it. When you think about development, it's unlike buying just an existing project, right? You have to have a 36 to 48 month foresight, which is, a lot of people, a lot of groups or, and companies, they don't have that. And so Michael's been sitting on this piece of land for a while, and he's waiting for the prime time to build. And, we partnered together and said, hey, look, let's time it the right way. And so I think this is the right time. So, another cool thing about Viking is we've had investors from literally all parts of the United States. We even have some international investors, but I think Utah was the last group of investors we don't have. And unfortunately, Michael Holman is from Utah. And so we're lucky that we're going to be able to get, say, 100% because he's going to bring some of his investors into this project as well.
Yeah, we'll have to break that trend. That's
all right,
for sure.
Let's keep going here. All right. And I mentioned this, but, offense and defense are two strategies any company needs to play. A lot of people love the offense, but sometimes defense is what matters. And especially during the last 24 months, it's been a challenging time in multifamily and in real estate in general, commercial real estate, especially if you've been in an office or other asset classes. But we're really proud of this track record. We've never lost a single dollar, never made a capital call, and we are continuing capital preservation. And, it's nice to have this, but we also want to earn people money. So we've been able to hit on our exits. We've had six or seven exits so far. We've hit a 24% average annual return. This will be our 28th asset we're acquiring, and we've acquired 5,700 units so far. So why multifamily? So, the reason why we love multifamily is there's so many reasons, and it fits into a lot of people's investment thesis, right? The cash flow is there. There's a long-term asset class stability. In fact, it's become the darling of institutional capital. We'll start showing you some slides where you'll see where the biggest REITs and biggest companies are plowing most of their money into that. It used to be office, call it maybe 4 to 5 years ago, but now it is multifamily is the largest allocation. There's year-over-year rent growth regardless because you adjust with inflation. And, especially now when it's really unaffordable to own a home, you want to have consistent housing. Rental demand is always there. There's appreciation over time. And if you hold it long enough, you will have the appreciation, right? There may be a blip or two in every 2 or 3 years, but if you hold any multifamily asset, I would say over a 7 to 10 year period, you are not going to have any concern for appreciation. There's tax advantages. You can do a 1031 exchange. You can do bonus depreciation, cost segregation. All of these things can protect your income and obviously the profit upon sale. All right, I think this is...
Yeah, thanks, Vic. But don't take our word for it. We're going to show you some numbers and some great macroeconomic backup for all of those reasons to invest in multifamily. Right now, as it's been for a while, and especially in today's market, and given where rates are, this chart shows the premier discount to buying a home versus renting a home. And as it shows, especially as happened in the last kind of couple of quarters, there is a significant discount to renting versus buying. Buying has become so cost prohibitive, driven mainly by the higher rates of financing a home purchase and by the fact that there are no houses therefore on the market. So you can't even find a home to buy. And if you do, snatch up in a matter of days at a high price. Renting has become the choice of people moving to different markets, and even people who are moving within a market, better off renting than buying a home, fueling that demand for multifamily apartments. And the long-term outlook of multifamily continues to stay strong. Going back to 2013, the orange line here is vacancy or occupancy, right? It's vacancy. So you can see coming down to, it was kind of up and down within 6.5%, 7%. Come the pandemic, there is no vacancy because everyone's staying put and sheltering at home. And then it spikes back up to normal rates in 2023. But the blue line shows market rents. Market rents have steadily, shown on the right side, grown over time. So almost irrespective of the market, rents, as Vic mentioned earlier, continue to grow. You reset them on a yearly basis, so they're really marked up with inflation, and really a nice growing asset to have in any portfolio investments. And unsurprisingly, the big players are already moving back into this space. And there was a bit of a quiet period where groups like us, nimble, quick, willing to pour through 2,000 deals to find the diamonds in the rough, like Vic mentioned, were kind of had our way of the land because the guys in the big firms weren't so active. Well, they've already jumped back in. They're already betting big on multifamily for the reasons I just showed you. And what our theory, our thesis that we were confident in has now been proven true. So for instance, KKR, a large private equity firm, they just paid $2.1 billion for a 5,000 plus unit portfolio. In addition, Equity Residential, another large multifamily apartment owner, bet nearly $1 billion on another apartment portfolio. These aren't small moves strategically set on a certain market. These are indicators of how the best minds on Wall Street, the best investment banks in the world are convinced that nationwide, multifamily has proven its worth, has shown its resilience, and they're making these big bets. And now is multifamily. Now let's talk about new construction. We had this, we've talked previously about how there aren't enough apartments there for the demand that exists. And we mentioned earlier why that demand is so strong. Well, something else that's just readily apparent is not only has not been enough construction to keep up with demand, but a lot of the units that exist are simply old. They're outdated. They're becoming obsolete. 78% of the apartments out there have been in existence since before the year 2000, before Y2K. Put it in the frame of reference for those of you out there. And as a result, the architecture, the size of the ceilings, the overall feel, these are much older units. And while firms like Viking Capital and other firms do a good job of going in and bringing the units up to a more modern appeal, you simply can't compete with a new product. A new product, newly built, not only is it safer, not only is it more tech savvy, and not only more appealing with better amenities as well, but it simply vastly outcompetes the older products.
Yeah, Judah, when we go into a new market, just to add to that, one of the things that gets us salivating is when we see a bunch of old apartment buildings, and that's the entire inventory in a market, because there's just so much functional obsolescence that exists with those units that no matter what you do, you just can't make them as nice as a brand new development. So I really feel good about that slide and concur with everything that you just mentioned.
Thanks, Mike. What the screen is showing now is something else that's very important for the market we're going to be talking about specifically, in addition to the nationwide multifamily development pace of construction. And that is, given what happened during COVID, which was for a while you couldn't build, right? Then construction was allowed again, but costs were all over the place. I mean, they'll probably tell you war stories about trying to finalize pricing on construction during the height of the pandemic. As a result of that, and also projects got delayed, and they got delayed into the delivery of other projects that were delayed, in that same 12 to 16 month period after the pandemic. And as a result, you had uncertainty of pricing, which pushed a lot of people out of the market. And you also had this huge delivery of apartments all at the same time, both the ones that were delayed and the ones that were already planned for that same period of time. As a result, some people saw some oversupply in delivery. You had oversupply relative to demand, oversupply relative to any annual absorption, and you saw a slowdown in projects being started. What that means is that there may have been a lot of apartments delivered over the last 5 years and into the next probably 9 months. But looking 12 to 18 to 24 to 36 months out, there aren't that many projects being built right now. The projects that are built in that time period will have the pick of the litter for the tenants chasing the newest product for lack of competition. And that is one of the reasons that in the market we're talking about specifically in Phoenix and overall, now is a great time to be starting new construction. And then this kind of just really is a great graphic that kind of just demonstrates that lack of supply. The undersupply of housing to buy for, owner-occupied single-family homes is the purple. Yes, that's certainly undersupplied. When you look at the rental supply, it's almost double that undersupply. And now we were in that place 10 years ago, but we certainly are now. And then absorption. This is when new apartments are delivered into a market. How quickly are they leased up? And what you see very nicely is, yes, there have been a lot of deliveries and, absorption for a couple of years went negative. And that's kind of the scary part that pushed people out of the market. But now going forward the next couple of years, and these aren't projections made up out of nowhere. In the multifamily world, when you have permits that are pulled and you have projects that are started, you really know the deliveries over the next couple of years. Looking out 25 and 26, the deliveries have gone back down, which is exactly why absorption is shooting back up. There's probably no safer time over the last 5 years to be building a new construction project than right now, when there aren't any others in the pipeline, and you have a higher guarantee, a higher surety of your apartments that you're delivering, being leased up at the fastest clip possible.
I want to really just stack what you're saying, Judah. Back one slide, please. I think this is a really important graph. This really is part of our investment thesis. Look, supply essentially, after 2025, supply falls off a cliff. And really, there's not much supply there. There's already a 1.5 million units shortage. We're in a very hot market of Phoenix where there's a lot of employment demand, population growth. And now by the time we deliver, which is in late 2026, early 2027 timeframe, there is no competition for this new supply, that's exactly the story. Thanks. So back to multifamily development. Why is it a game changer? Well, by giving our investors options, it's almost another way of diversifying their portfolio within multifamily, right? It's a shorter hold period, right? 24 to 36 months, 24 months of like starting to lease up and 36 months to get ready for sale. We're going to be able to redeploy people's capital faster. We can 1031 it after we sell it and redeploy. It's a core asset, very stable, a flight to safety. This attracts the KKR, the Goldmans, the Brookfields of the world. All these institutional investors want this type of asset. It's lower risk. It's appealing to a higher income class, higher tenant base who is not so affected by economic cycles. It's definitely appealing to millennials and higher potential. And so that presents us to a Peoria Gateway. So this is our 200-unit 2026 delivery project in Phoenix, Arizona. Peoria is a thriving suburb of Phoenix, just 12 miles away. So I would really call it just the Phoenix MSA, really. And beautiful design, beautiful look, very attractive for tenants who would want to live here. Next. So the key reasons, we've already hinted at a lot of this, and I encourage Michael and Judah to sort of stack on some of the reasons why this project makes a lot of sense and why we like it as Viking and Overland. But it's basically a prime location, right? This is a path of progress, and it's hyper-connected. There's so much growth along this corridor toward Peoria, which is northwest Phoenix. It's a competitive asset, great set of amenities. If you guys like pickleball, there'll be a pickleball court. There's keyless fob entry, Nest thermostats, the whole bit. It's going to be really, really nice project. We have expertise now in Phoenix with development. We have proven products that have already come online. We can see what the rents are. And so this is more of a rinse and repeat strategy versus, trial and error. Low risk fundamentals. We're building all in close to 300 a door. This is going to sell for 400 per unit. And so that's our arbitrage right there. And then we've talked about the low supply. And, we hadn't planned on the low interest rates being cut by the Fed, but that just adds fuel to our fire and adds more ability for us to probably generate even a higher return.
I mean, one of the things, Vic, that I just want to mention there that I love, that you kind of touched on at the very end, is this deal. I mean, we've really approached this deal with good fundamentals that are, based on what's happening in the market, only likely to get better or more favorable in the next coming months. And so, I mean, we're very close to shovel ready, but the things that happen over the next few months really have the opportunity to work in our favor significantly, which I think greatly de-risks the project from just a financing and overall market standpoint that always exists. When you're here kind of at the top of the market and you only have the opportunity to really get better, that's a good place to be in, and not a place that we've been in, especially in the development world, for years. I mean, for a long time, construction costs were only just going up, interest rates were only going up. So to be at a place where you really feel like the horizon only makes projects better is a really exciting place to be.
All right. Go for it, Judah.
Yeah, sure. I'll go over the capital stack here. Our estimated cost of the project, $62 million. With beneficial kind of layered financing totaling $43.3 million with 3-year hold. There will be a GP investment here alongside all of our investors' LP investment with two classes, one at $12 and one at $4.7 million. That part our investors should be pretty familiar with, and we'll certainly go through the structures in a moment. As mentioned earlier, this 200 units, estimated completion in 2026. And if you remember from a couple of slides earlier, that's when deliverables really drop off in the market, nationwide in this market as well, meaning we'll be probably one of the, if not the only, new construction delivered then, certainly in the submarket, which is advantageous for many reasons. Large floor plans, 957 average, will definitely attract some of the top tenants in the market. We have mentioned many times in our webinars about the flight to quality. Given where the rental market is now, tenants are allocating their dollars competitively, looking for larger units, nicer amenities, newer properties, and we're going to check all three boxes with this project. It is a beautiful property. I mean, I was at the site right now, and this is going to be a gem in the neighborhood that is really squarely in the path of progress. You see here the pool, the pickleball court, and even I think that was cornhole in the middle. not to be neglected. I don't want to run through all the amenities here, but there's certainly going to be amenities that are going to attract really the top tenants: fitness, work from home, pool, and a whole hangout area, in addition to units themselves having top of the market features, appliances in terms of finishings in the kitchen and the bathrooms, as well as the living areas. And this will be, a 20-month construction timeline. One of the benefits, though, Michael's group has proven really adept at going and constructing building by building, what gives us the benefit of leasing. As soon as you have a C of O on one building, you lease it up. Even if the next building is not complete yet, that'll enable us to actually have cash flow during a new construction project. You don't often see that. And it's a really great unit mix. 1 bedrooms, 2 bedrooms, and 3 bedrooms. Want to note that both there'll be 2 and 3 bedroom townhome units. Going through the comps in the area, not a lot of townhome comps. Surely not ones as new as this. And the ones that have a few townhomes, we're talking to leasing teams, they're very, very attractive tenants to the market. We can keep moving on here. Okay, great. So let's talk about structure here. Again, a lot of our investors may be familiar with our structure. For those of you who are not, we will have 2 classes of investors here, a B and reserve. B, 7% preferred return, which means B investors will have a 7% position before the GP sees anything. An 85-15 profit share. You may be used to 70-30. Again, one of the reasons for new construction is there is higher rewards to share, allowing us to really share more of those rewards with our investors. Here at 85-15, with 85 in favor of the Class B investor, $50,000 minimum there. For the reserve class, those of you investing at least $500,000 into the project, you will get an 8% preferred return and a 90-10 profit share. Again, we offer both and are happy to explain more about the benefits of each investment class. Feel free to book a call with our team, and we'll discuss what you can do personally as an investor. I mentioned this earlier, but I think it's worth visually looking at the capital stack. There's going to be the debt, the G equity alongside the LP equity, with the lion's share coming in that Class B, and then a reserve as well. It's a 3-year hold projection. And again, multiples of 1.8, 1.9x. We're usually seeing those multiples on a 5-year hold. Here you get to see them on a 3-year hold. It's essentially the same dollar for dollar returns on a shorter time period, letting you reallocate that capital more quickly than you otherwise might be able to do. And then on an annual return basis, it's a much higher return profile. Again, one of the benefits of new construction, why we recommend allocating some new construction into your investment profile.
And that's why the IRR is elevated, guys. 21% for a B and 23% for reserve. So there's a shortened time window of higher returns.
Yes. Here you can expect for typical average Class B investment of around $100,000, and the reserve class as well, just so you can kind of put that multiple into actual dollars. And as we always do, we provide a sensitivity analysis. We don't have a crystal ball. Michael almost has a crystal ball, but none of us actually have crystal balls. And therefore, we want you guys to see, let's just say our exit caps move 25 basis points at a clip in either direction. That obviously will impact our exit price significantly, almost $10 million at the extremes here, but it's still very handsome returns. So it's one of the reasons that we're excited about this project. This is the Class B analysis, and if we go on one more, you'll see the reserve class analysis as well. Again, these will all be available in replay, and encourage you to take a deeper look and have a call with our team to go through all this in more painstaking detail. Again, the loan principal is going to be 37.3 for the actual debt financing. It's a 54% kind of loan to value. There'll be a pref equity slug, kind of sort of a mezz debt layer behind it in the form of pref equity. The rate of 8% will be adjustable, as it always is on construction loans, with the full term being interest-only payments. And here's a breakdown of the actual costs. Unlike other deals where you may not see the slide, it's worthwhile for you to see what that total deal size is, where it's coming from, right? So there's land costs, and land here has already been purchased and fully entitled, by the way. It's often a risk you'll have in a new construction deal. Here, Michael's team has worked hard to get this deal completely entitled. What that means, there's no zoning risk. Some of the other legal risks that you might have in a construction deal are already in the rearview mirror here. That's some of those soft costs. You've seen $11.7 million. That also includes design costs, architecture costs, and then you have the actual hard costs, the actual costs of the materials to build the property. That a total of $61.5 million. Our disposition price, $86.7 million. That's $25 million in value we'll be creating over that 3-year period, a creation of value of $125,000 per unit.
And we're building it all in for $307 a door, and we're selling it for $433 a door. And this is based on, the current evaluations. Now it can change.
And we're not even so aggressive. It wasn't that long ago that you were seeing 1980s product and early 90s built product in Phoenix selling for $400 a door. So we're being pretty conservative in these estimations. And again, excited about this one. Here's a good side map. Michael's team has done a great job designing this. I mean, it's a modern look, stands out from its competitors, again, with the goal of attracting the top tenants. I'm going to look at some of the amenities here, although I do encourage you to watch the replay, pause in on some of these slides, and get a good look at some of these amenities. On the ESG front, we're always looking for ways to help the environment while also generating revenue, and solar panels in some of the common areas and amenities are going to be kind of better for the environment, benefiting from the Phoenix sun, while also making our property more eco-friendly. Again, top finishes here in the clubhouse, the lounge area. Again, this is hopefully convincing you guys why tenants will be able to pay top dollar, willing to pay top dollar to live here. Now, again, a visual of the unit mix, a lot of one bedrooms on this. We mentioned before, this property is well located. It's got great connectivity to downtown on Grand Avenue, which is a thoroughfare that runs then through Glendale into downtown Phoenix. And this property really will attract a lot of young people looking for their own space, and therefore the one bedrooms we expect to be of high interest. 2 bedrooms and 3 bedrooms, you will have some people who want roommates, you will have some families. This unit mix is really profiled very well for the immediate market.
And I think, Michael, we were talking in the green room, but this is only 12 miles away from Taiwanese Semiconductor, right? This is a huge chip manufacturer in Phoenix, and it's actually very nearly located to Peoria. And if all these kind of jobs are being created, people would want to find a nice place to live, and would be a great example of that.
Absolutely. I mean, that's a huge, billions of dollars investment into the area, thousands of jobs being created, all from this one investment. So it's a huge driver for this northwest quadrant of Phoenix.
And this is really what it comes down to. Aren't a lot of fancy pictures on this slide, but there's some important information in terms of the rent comps, right? These are comps that are already built. These are the rents that they're getting now. When we deliver this project in 2026, these buildings will all be anywhere from 5 to 6, 7 years old. And again, we're projecting rents to be competitive with these, even though we'll have the nicest property in the neighborhood. So it's these nearby properties that provide the support for the revenue that we expect to generate when we stabilize and then sell this as a stabilized property. Again, I think we can really beat these rents, but on a conservative basis, 98 per square foot is certainly in line with the market. And then our development timeline. This is, again, a new slide for those of you Viking investors who've joined us tonight. So one you may want to pay a little bit of attention to because it goes through the timeline for this project. There's a lot going on in the 3 years we're going to own this property. Again, we're already fully permitted. We're now at the top line, approaching the equity raise. And this is important because we lock in the financing right after this. And, the way the financing works is that everyone brings their money to the table. So our equity has to be in place in order for the lenders to put in their debt. And that really starts construction. During the 20 months of construction, we will be delivering those first units, 14 months in. At the end of the second line on the left, leasing begins while we finish up those last buildings. So we'll get tenants in place. We'll start cash flowing earlier on, thanks to the way Michael has really planned the construction and the way we're delivering these buildings. We'll then stabilize, hit stabilization, where we will get this thing fully leased. We'll be hitting market rents, burn off any concessions that we may use to, rent at a more pace than the market might otherwise offer, and then sell this opportunistically after 3 years, fully stabilized, to a group looking to buy and pay top dollar for the nicest property and with the highest rents and the best tenants in the market.
Yeah, and thank you again for all the great questions, guys. We're going to try to get to as many of them as we can. And also, please take a chance, take an opportunity to book a call with our team so we can get your private questions answered, because then we have a lot more time to go through all the details. But we're trying to do our best to answer as many questions as we can, and we have a few more things we want to share with you guys. So quickly, this Peoria Gateway is located very close to entertainment centers, outlet malls, sports complexes, art museums, kids' fun areas. So all of it is very close by. Mixed use development as well. Peoria, as a submarket of Phoenix, is considered a master planned community. It's one of the very attractive place to live in Arizona, one of the boom towns. Next. And you can see here, we have universities nearby, sports complexes, major employers like Honeywell, which is an aerospace company. I mentioned Taiwanese Semiconductor, which is not too far away. We got, all these other medical employers as well. So you got the Mayo Clinic of Arizona, which is nearby as well. Next. Phoenix is also known for spring training for a lot of MLB. So the Peoria Sports Complex hosts both the San Diego Padres and the Mariners. And all of this is, the reason why we're sharing all this is because of the economic impact. Each thing has, a couple $100 million of economic impact. They're building a very private aviation park here. This is where people have private flights coming in and out. There'll be an industrial complex as well. They estimate the annual impact to be $1 billion, and that's coming online in 2026. There's a really nice food hall, community space, mixed-use restaurants, bars, retail space in a revitalized downtown. So when we're talking about path of progress, this just exemplifies what we're referring to. As I mentioned, I'm in the healthcare space, and so healthcare is near and dear to me because it's essentially a recession-resistant industry. And the fact that Arizona's leaned into it, Phoenix has leaned into it, and Peoria is like sort of a hub of medical is good because in real estate, we love having med and ed in our units. And so these are like people who are in the medical profession or educators, because usually very stable job situations. And so you can see here, we got Mayo Clinic, you got the Cigna Group, you got Banner, which is one of the largest medical hospital organizations in all of Arizona, all located within a short distance. A new development, Honor Health is building this medical campus, 100,000 square foot facility with all these cancer care, physical therapy, GI, everything is all there. And this is all close to Peoria. We got mixed use coming as well. And Phoenix as a city is close to obviously Vegas, California, San Diego. So there's a lot of explants who are leaving California and they're making Phoenix their new home. Scottsdale is considered like the crown jewel of Phoenix, which is very close by. You got Tucson, where University of Arizona headquartered. That's becoming a major city now. Flagstaff. So it's really the center of everything. Okay. And now we're going to get into Phoenix. It's surprisingly, I didn't realize this, but it's the fifth largest city in the United States now. Number one manufacturing hub. It's a number one silicon chip hub. And obviously the airport's starting to get more and more traffic and becoming a major player. The population growth is really the story here, right? Where population goes, there's jobs. And where there's jobs go, there's demand. And there's demand, there's people who want to own or rent. And in this case, it's mainly rentals. And so that is why we track these kind of things. And we do demographic studies before we choose locations. And so this is our first foray into Phoenix as Viking, and this is our first foray into development. So we were very careful with all the research and the data before we pulled the trigger here. And this exemplifies where the population growth is going. The population growth is also outgrowing the U.S. in terms of where the fastest growing metros. And we mentioned the net migration. This is one of the number one states for top MSA net migration. And here's the story of housing versus renting, right? On the left side, you see the average home price, $525,000, right? The national average is about $420,000. This is 25% above. Same thing with the rents. Rents, national average is about $2,000. We're at $1,367. So there's an opportunity for rent growth, and there's a lot of room because no one's going to want to pay this kind of housing prices. It's unaffordable for most people. And so this is really the arbitrage opportunity for us. And many people don't realize this, but there's actually some restrictions on growth in Phoenix and the surrounding areas. And the reason for that is there's a lot of indigenous population, Native American population, and so they have reservations that you are not allowed to build upon. There's also natural barriers such as mountain ranges where it's difficult to build, or essentially if you build on the other side of it, you're disconnected from the main part of the city. And so because of that, there's some restriction in supply. And so that also portends well for us building in this area. Higher education is always a good sign for an attractive tenant base. And so you have Arizona, you have ASU, some of the top universities in the area, and you have all these other ones as well. We've talked about employment, and it's actually beating the national average consistently over the last four years now. And so some of the top employers, and this is important for investors to know, hey, like who's going to actually live in these apartment, buildings? And it's, we have the medical space, we have Banner Health, employing almost 9,000 people. We got Apollo Education Group, the University of Phoenix Online, that company that you've heard of, that's the parent company. Honeywell is a space aviation company. American Express is a financial company. We got St. Joseph's, another medical company. So a lot of diversity in the employer base and a significant amount of employment. During 2008, during the great financial crisis, I'll be honest, Phoenix was not the place anyone wanted to be because they got hurt. They got hurt pretty bad. And I'll actually lean into Michael on this too, because he's studied this market quite well. But, I'm impressed with what Phoenix has done over the last 16 years, right? They've really reinvented themselves. They've become this major hub where wealthy people all are like building these mega mansions in something called Paradise Valley. You got healthcare companies exploding here. It's become a Silicon Valley hub with all these semiconductor companies. And then the electrical vehicle companies like Lucid are coming here. And then, we have now sports and entertainment really making it as a major tourist attraction. So with that diversification, this is not the same Phoenix. And, we went through some hardships last 2 or 3 years. Phoenix did great. Michael, do you want to stack on that?
Yeah, absolutely. I mean, the Phoenix was one of the markets that probably did the best job of learning from its mistakes in 2008, right? It wasn't as diversified as it needed to be. And it has been a very concerted effort as a state and as cities across Phoenix MSA to bring in that diversity. And there's a lot of government money, a lot of municipal money going towards that goal of that diversification, right? I mean, Phoenix was not historically known as a tech hub, right? I mean, data centers weren't necessarily a huge thing. You got Intel, you got TSMC, you got these huge groups coming in here, but that's not all. Like you said, the diversity is really broadened. And then the other little secret sauce to all of this on why you're seeing a lot of the diversity is the lifestyle in Phoenix. The cost of Phoenix is really high value. I mean, you have people moving to Phoenix in droves because all of a sudden they realize I can be in the outdoors. I can live the lifestyle I want to live. I don't have to pay $2 million for my house. So you're getting all of these people moving in and a diverse set of people moving in that has been happening for 10 plus years. And what COVID did is COVID just accelerated that. COVID didn't change anything that had been happening in Phoenix for the last 10 years. It simply provided an acceleration because now people could go live where they wanted to live, which was Phoenix.
Also, we talked about how healthcare is important and it's a key economic driver. And so the economic impact on the state is $78 billion, and it accounts for almost 1 million jobs in the state. So it's powerful, and that's a good thing for a lot of our tenants. Next, we mentioned Mayo Clinic. Again, number one hospital in Arizona for the 12th consecutive year. Nationwide, there's multiple Mayo clinics, one in Florida, one in Rochester, and one here in Arizona, $28 billion of overall impact, but the one in Arizona has about $4.7 billion of impact. And people come, there's medical tourism. People literally fly in from parts of the country just to get treated here at the Mayo Clinic. GDP is growing, both in the state, obviously, as well in the country. Next. And these are the important slides I want to get to. So Intel just announced a couple years ago that they're going to build these $20 billion 2 fabrication plants where they're manufacturing these semiconductor chips. And so they refer to this as, there's Silicon Valley. This is called the Silicon Desert. And so it's going to count for a ton of jobs and a ton of impact. Next, Amcor is a company that has a Peoria campus, and they're testing and producing chips for Apple computers at the Taiwanese semiconductor facility. And then this is what Michael's referring to, the $1.2 billion of investment by Taiwanese Semiconductor, TSMC. They're planning on it bringing close to 80,000 jobs to Phoenix, which is amazing. So I'm going to rip through these slides quickly so we have time for some Q&A. But, the statistic here is visitors spend $77 million per day across Arizona just seeing attractions and sites. Next, this is a phenomenal new resort opening in 2025. It has Vegas-esque vibes, and it's essentially like a beach, luxury hotels, resorts, water park, concert arena, all in one place. It's $1 billion, and then they're gonna open it up in 2025 next year. Next, Super Bowl, we had it last year here, $1.3 billion impact. Next, the Waste Management Open is one of the top PGA events out there, and more than 700,000 people come to Phoenix every year just to attend it. Next, you got Polo Championships. Next, Lake Pleasant. The interesting thing here is it provides $7.1 billion of GDP growth for the state, and a lot of benefits to the state both for water preservation and for the income that it provides. Next, State Farm Arena, $24.2 billion. The Phoenix Suns play here, and the Cardinals. Next, 15 different MLB teams have their spring training facility in Phoenix, and that's called the Cactus League. Mattel just opened up a new adventure park. This is essentially like a Universal Studios kind of thing. It opened up this year, actually, 2024. They expect $13 million of impact per year. The NASCAR has a big facility. And then Lucid Motors, the electric vehicle company, $100 million of impact, 6,000 jobs were created. And the airport is really thriving, $44.3 billion. They've redone the whole airport. It's pretty amazing, and they have a lot of traffic. And now we're doing the planes, trains, and automobiles. So we got the investment in BNSF and the railways. So now we get to how you can invest. So guys, we presented a lot of data, a lot of research, a lot of information, thought processes on development and why it makes sense, timing, why we're choosing now, why we chose our specific partners, and really why this is the next part of Viking strategy with existing assets now and developing assets. And so it's really a continuum of what we're offering as we expand who we are as a private equity company. So the way you can invest with us in this asset or any other assets would be the 1031 exchange, self-directed IRAs, cash. You can use, 401ks, trusts. There's different ways to get involved. And I want to just chat a little bit about 1031s. The reason why this has become very popular is it is one of the most, proven tax saving strategies and wealth creation strategies that many of the most savvy financial people use. And so, it allows you to do a lot of things: estate planning, compounding wealth, tax deferral, portfolio diversification. So, and I'll tell you this, we've had a significant amount of money coming into this deal already from 1031s. And so that shows, number one, that this is a really good strategy to employ, but two, the popularity of this investment. Next. And so for those of you who don't know what 1031 is, it's a protocol in the tax code that allows someone to dispose of a property, find a like-kinded property, and identify that and go ahead and invest and roll over all the income and the profits without having to pay taxes. And you essentially defer the taxes for a later date. And if you do this right, you keep deferring it to where the quote is you swap till you drop. And so when you do that, then you can pass this on to your heirs with a step up in basis. And so that's, the name of the game there. Next. And so really, guys, if you really want to know more about this project, the best way is to jump on a call with our team. But I want to make sure we have at least a good 10 to 12 minutes here answering your questions. And so let's go through some of the questions we've already gotten from many of you. These are probably some of them. And then we're going to go through the Q&As here. So Judah, why is Viking going away from its tried and true strategy of just buying existing assets and considering development? What do you think?
Yeah, the truth is we're not really going after anything different than we usually look for, right? We usually look for asymmetric risk reward, right? We're looking for properties where the reward outweighs the commensurate risk that's typical for that type of investment. So where we usually would look for multifamily value add type projects where the amount of value you add outweighs the risk of buying that type of property. It's no different here, right? There are risks inherent with ground up construction. Again, I mentioned earlier, we've gone past a lot of those risks, the entitlement risks that they're called. Michael's team has already moved us past them. But the reality is, in this location, in this market, the rent's already proven out. The cost of construction that we were able to kind of lock in certain ways, the opportunity we see outweighs on an adjusted basis that risk. And it offers greater returns than a typical value-add property would return. Normally, we're shooting for that same 1.9 multiple on a 5-year basis. You have an opportunity here to get on a 3-year basis. Those annual returns then shoot up from 15 to 17% up to the mid-20s, allowing our investors to reap those same benefits on a more accelerated basis and then hopefully reallocate them to another opportunity. So again, the fundamentals underlying the multifamily market are the same. There are a lot of benefits to new construction. As I mentioned earlier, much of the 78% of the product out there in the multifamily world is nearing obsolescence. It's from pre-2000. So we have the opportunity to deliver brand new product, be the top asset in a market that is within the pathway of progress. So again, a reward that outweighs the risks, which is again what we always look for.
So I have some questions about, hey, is there cash flow in the deal? This is from the Q&A. How do we answer that?
Now, often in new construction, there won't be cash flow. You build it, you lease it up, and then you sell it. Here, again, because we're delivering building by building, we will be able to start leasing up the units as soon as the first building is done, which we believe will be around month 14. And with them, full construction by month 20, full construction, full lease up by month 24, spend a year stabilizing. So from month 14 through 36, we expect there to be some cash flow and it growing month by month. So again, you have the benefit of cash flow during the life of the project, not from day one. Right now, it's land, but certainly from more than half the project, we'll have some cash flow. But again, the benefits and high rewards of a new construction project.
Awesome. And before we get to Michael on his question, I want to just clarify. So people are asking what's the deadline for funding. So this project already has $5 million of investors involved in it. That leaves about $10 million left. And so we think this is going to get finished up by end of September, likely. So probably September and probably maybe a little bit into October is your time window to get into this project. Michael, what are the risks of development and how we protected our investors against that?
Yeah, I mean, that's a great question. And like Judah said, one of the biggest risks with the new development is going to be entitlement risk, right? I mean, to kind of give you some foresight, right? Nobody's coming in here in the front end. So one of the ways that the risk is really mitigated, we've owned this property for 2 years now, coming up on 2 years. This is not new. And we've been under contract for even longer, about 2.5 years. And so The reality is we've been working on this project for that long of time. So the timing here that Vic is talking about is really important, right? As a developer, we get the project to that point, we get it entitled. Vic and Viking has done a really good job about the timing of when they approach and come into this project, right? That entitlement risk is gone. I mean, there is no entitlement risk. We're fully zoned, site plan approval, design review approval, the whole bit, right? We worked with the mayor and the city council, everybody to get that through. So the risks that are remaining, you're going to have financing risk, construction risk, and lease-up risk. Those are your three, right? We've solved entitlement risk, which is generally the largest risk that you're dealing with. But those are your three risks that you deal with in a multifamily new construction, right? And really with the financing risk and what I look at that's really, as much as I wish I had a crystal ball, I think that's about as favorable right now as it possibly can be, right? Given the circumstances in the market where I think 99% of us would predict it's going, the financing risk is actually likely to only get more favorable to us. So that really leaves you your construction risk and your lease-up risk before you exit the asset. The construction risk, Overland Construction will be building this project. We've built a lot of apartment units and a lot of buildings. Like I said, we currently just right now have $200 million in construction. That's just our own stuff. We're also actively working on a lot of other third-party work as well. So as far as the construction risk goes, we feel very confident in the abilities to construct this project on time, on budget. And we've proved that multiple times and on multiple projects. And that leaves your lease-up, which is the market, right? And everything that we've done and that Viking specifically has done to assess the market. In fact, this whole presentation, right? If I'm throwing a few flowers to Viking Capital, this whole presentation is about understanding that market, that lease-up risk, and how to mitigate it, right? It's there. It's always going to be there. But through good asset management and selecting good properties and good locations, you can really mitigate that.
And just to stack on in terms of construction, when we vetted partners for our first ground up project, there are many firms out there with even good reputations, but they don't have their own construction team. They just manage a construction team as third party, which is a big layer in between the developer and the actual construction team. We were very happy to work with Overland and Michael and his father because they have their own construction team. It's in-house, full control, and that's one less layer to have to go through. It offers more transparency and more control over the project. So that was something we looked for, and we're happy to have it on this deal.
Yeah, the other thing is we wanted domain-specific knowledge, so they have domain-specific knowledge of Phoenix and that market. The second thing is they use, I think, GMAX contracts to where they're sort of capped at how much we're not going to have any big overages, which is that's the key to really keeping costs under control. And they've always built their projects on time and in high quality, which is great. And we've seen their previous work, which is what gave us confidence to partner with them. So we've talked about cash flow. We talked about Viking's additional diversification here. What about rates, guys? Should the investors be concerned? Should they be worried about the rates?
Yeah, that's a great question. As we mentioned opening this, right now they're expecting a cut. Will it happen? Won't it happen? No one knows. One thing that's not expected is any rate hikes. If you look at the forward SOFR curve, and I believe the rate's based on SOFR, it is actually projected to go down over the course of our construction project. So there's limited ways about going down. I mean, it is a floating rate that has a floor to it. But the big concern is, will rates go up? And every economic indicator out there, every expert, every talking head on TV certainly does not expect rates to go up. So whereas a couple of years ago, more nervous to go into a floating rate deal and in a floating rate environment where rates were at all-time lows and can only go up if anywhere, here they're expected to go down with no real risk of it going up during the course of our project.
All right, guys, I got a couple of good questions here. I'm going to ask this to Michael. What is driving supply drop off after 2025? That's Heidi asked that really good question.
Yeah, well, Heidi, the reality is it's the market, right? And interest rates are a big driver of that, right? Is it gets more expensive to build projects and there's more uncertainty in a market, right? Which was existing a lot in 2023. There's a lot less development that happens, right? There's a lot less transactions and activity across smaller groups, but also large institutional groups. And where developments take, on average, call it 2 years, 2.5 years to construct, what happens is anything that's going to come online in 2025, 2026 had to have started in 2023 or 2024, right? Well, you have a huge drop off in starts, which means if you have a huge drop off in starts in 2023, 2024, that means you don't have any new product or any new properties coming online during that 2025, 2026 timeframe. That leaves this huge gap because demand, especially in Phoenix, as was shown in the presentation, demand continues to grow in Phoenix year over year at a rapid pace, right? And so there needs to be more units in Phoenix overall to meet that demand. Well, if you're the brand new property and there's not another new property in 2 years, when you start seeing that turnover and those new people moving in, you're often viewed as the newest, shiniest toy. You can charge the highest rents. You have the most lease-up velocity. And so that's a really powerful position to be in. That's pretty unique, right? Not a lot of people got to play in that, because if you were a developer with institutional capital and that spigot got shut off, there's nothing you can do. You're stuck and you can't develop. So there's a really unique and interesting opportunity that we have here.
Yeah, and I would just play on Michael what he's saying. So think about it this way. What we're trying to do is we're not trying to hold this project for long. Once we build it, our goal is to get the highest amount of people in at the fastest amount of velocity with the highest rents. And then that NOI that gets baked in is the multiple which we get to sell it for. And that's the profit there. And so if the time we're coming online and leasing up and able to get the premium rents, that just increases the multiple for our investors, which is that's the whole game. Someone's asking, as interest rates decline, don't you expect home ownership to increase, and how that will affect the rental markets?
Yeah, I think that when rates come down, you'll start to see more houses being sold. But the underlying problem of construction that Michael just described, they really carry forward for not just multifamily apartments, but also single-family home construction as well. So sure, I expect to see an uptick in construction also. But again, you're now 1 year, 2 years, 3 years out. Our project should be kind of ahead of that. And if you remember the chart before, there was a vast gap and divide between the undersupply of homes versus the undersupply of apartments. So there's a much bigger cushion on the apartment side than there is on the single-family home side.
People are asking about tax benefits and depreciation.
Yeah, so I mean, generally, as you've seen throughout our projects, and you haven't, happy to talk about it here, the newer the product, the more value there is to depreciate. Right. So when we buy in our value add space, new construction, 2005, 2012 construction, there's more depreciation than there is in a 1960 built property. So here, the same thing, there will be depreciation. Michael, maybe you can speak to on the new construction sense, where it comes in and when it comes in, given that it's not simply a new acquisition, but a development.
Yeah, so it comes into play when the asset is placed in service. So we go through construction. Once the asset is placed in service, meaning that we actually start leasing it, that is when we will kick off a cost segregation study. The beautiful part, right, which is common among all assets, the beautiful part about a new construction property when you're doing a cost segregation study, we know where every single penny was spent, right? Every single penny that was spent on this dollar, we have backup documentation. So it becomes really effective on the depreciation side. When we go give that to a cost segregation study, an engineer or the CPA or whoever's doing that cost segregation study, they can go in and they can maximize depreciation to the fullest extent because they have actual hard data to back up every single one of their numbers.
Okay.
So yes, there will be depreciation. It just comes at the project delivery as opposed to on the front end.
Great. I think people are asking about is there a waterfall and how that works?
Yeah. So there is a hurdle, but again, it's much more beneficial to investors in our typical project. In our typical project, once we hit a 13 IRR, maybe a 15 IRR, it splits to a 50-50 split. Here, the hurdle is much higher for us. It's a 20% IRR. Only after 20% IRR are we flipping a 5% difference. So if it was 85-15, it'll go to 80-20. If it was 90-10, it goes to that 85-15. So a much limited waterfall and hurdle.
Limited waterfall hurdle, much more favorable to investors. That's awesome. And bonus depreciation is present. So good, guys. I think we answered a lot of the heavy questions here. I know there's so many really good questions you guys have asked, and I want to capture all of these as well. Click on the QR code, book a call, text Peoria. We're trying to be one of those cool cats with the texting, 826-205-0259, I guess. You can email us. We would love to answer all your questions. We have a whole team on standby. There's already been a lot of buzz and interest for the deal. So let's get you guys on a call with our team. We can go through detailed analysis, underwriting, anything you guys want. We want to show you. We want to open up the Komodo, show you exactly how we've thought about this deal. And we're excited. We think it's going to be a phenomenal project, and it looks amazing already on the rendering. So thank you, Michael. Thank you, Judah. Thank you, everyone, for taking your evening and learning about this investment project, learning about Phoenix and Peoria as well. So, guys, until next time, have a good night. Be phenomenal.
Thanks, everybody.